Hey guys, welcome back to another week of fundamental analysis. This is 2 weeks combined. I've got the 16th of December to the 28th of December because I didn't do it last week. Um, yeah, we're going to go through the 2 weeks. I will have a little break in between. I'll still be doing what I need to do on my end. I just won't be recording end of the year. We're not trading, so let's just go through the 16th of December to the 28th of December. Just a continual reminder that this is not financial advice. This is me just putting my thoughts to the wind and, you know, obviously one day having you guys see all this work that's been done in the back end. And just essentially it's not by chance. Right, so COT, earliest or latest COT data we have is from the 17th of December. Because of the holidays, the next reading will come out on the 30th of December, which this is prior to then. So we'll take what we can get. Guys can see the previous weeks the yen was accumulating, but now yen's been shorted. Aussie, I've found in the past several COT reports have been shorted. I think for the last 3 or 4 weeks now. So really just showing a lot of selling pressure for Aussie, and combined with quite a nice bias change to the US dollar and a lot of strength in the US dollar. AU's looking like a good setup in terms of the forex pairs I trade. Gold has been on a tear, has been bullish pretty much this whole year, so that's still remaining true, and it's at a whopping 88% long bias right now. So quite an interesting report for our setups, at least. US and Aussie sort of pair well. We've got gold as well pairing well. We've got US 30, which is the index I trade. Although there is a bias change. Let me just have a look. 4.26%. You guys can see, like, in terms of the indices, they're still quite long based, especially the S&P 500. US 30 last week was long based as well, so and NAS as well. So really good setups from a COT reporting for our pairs. But let's go on to the big sort of economic news. We had rate cut, a minor rate cut, 25 basis points this week. We had core PCE coming cooler than expected, but we'll take a deeper look into the graphs for that one. We have GDP actually hotter than expected, so compared to their preliminary reading and advanced reading of both 2.8, a whopping 3.1 US is still doing great. Core retail sales, although lower than expected, retail sales, which is inclusive of automobiles, new and used automobiles, has actually increased. So we'll go through retail sales as well as core retail sales later. And consumer confidence cooler than expected in regards to expectations for the future. So overall, I'd say this is bullish for the US economy. We have good GDP, we have good retail sales and spending, although consumer confidence was a bit lower than expected. Still a very, very good, strong reading. AU, we had Westpac consumer confidence being cooler than expected, or worse than last previous reading. Actually in the negatives, so outlook for AU right now isn't great, which sort of pairs well or pairs nicely with the COT reporting. Now, in terms of more details, we had increase in retail sales, trending up generally, good spending, and obviously reflective of the US economy. Most people spent on new/used cars, which is the difference between core versus non-core for retail sales. So you guys can see core retail sales was 0.2, retail sales was 0.7, and both were revised up from their previous reading. So very bullish actually on retail sales. And then I just put a little note that, if people are buying new and used cars, this is more of a risk-on environment. People are spending on luxuries such as cars, which isn't a necessity, which just shows the environment that we're kind of in right now. So, especially with Trump in office and tax cuts, um, indices are a nice trade right now. FOMC, we saw a basis 25 basis point rate cut. The FOMC meeting also predicted fewer cuts next year, so from originally 4 cuts reduced down to 2 cuts is what they said, which is a dovish report. And they also reported that the rate of inflation remains somewhat elevated, and that's that whole element of stagflation. People are still spending, even though the interest rates are quite high still. So really, if we have fewer rate cuts, it's still a risk-on environment in my personal thinking, because we're still getting cuts. We're not keeping it the same, but fewer cuts means maybe the upside isn't that much. But I'm going to still take it as a positive sign for indices, and the element of stagflation, we might actually trade gold again. So we'll see. GDP, we had final GDP from 3.1 from the further 2 estimations. Very good outlook. And sorry, my camera's in the way, so I'm just going to read there. Very good outlook into the US economy. People are still spending, as evident from retail sales. So yeah, like I said before, GDP and retail sales quite bullish. Consumer confidence, worse projections, but labour market doing as expected and well. So pretty good, very good readings. Now let's have a look in more detail. So I've started using charts from investing.com over previous Forex Factory. I think it looks cleaner. I think it provides a bit more detail. You guys can see we had cuts for the last 1, 2, 3 readings. We were down from 5.5 to 4.5, 4.5%. So pretty good. Yeah, good trend down. Might have to slow it down because of inflationary sort of pressures, but trending down, which means theoretically we should be more on a risk-on environment. People more borrowing, more spending essentially. Now let's compare it with AU cash rates, which is obviously my country, Australia. You guys can see we've been pretty much this whole, I'm pretty sure it's almost a year, the AU cash rates has been the same at 4.35. Again, we didn't rate hike too aggressively, so there isn't that sort of bounce back period. I think we can ease off slowly in 2025. But for myself, just again as a citizen in Australia, in Sydney, I'm doing pretty well. I can still buy things. I can still live the way I need to live, even at these current interest rates. I don't own a property, so that might be one thing. But yeah, I think in the next year, 2025, we'll see a little trickle, somewhat similar to the US actually. With US being aggressive first, now they're coming down earlier. I think we're both gonna drop rates at the same rate. So we'll have to see. Now, inflation reading, core PCE, month to month. So the year on year, you guys can see it has been trending up, which is above that 2% target. We were getting close, but now we're trending back up. From a month to month perspective, we have gone down from 0.3 to 0.1, so there is a little bit of element of slowing down, but this year on year reading pretty much gives us elements of stagflation, elements of concern, where ideally we would have wanted hovering down here at 2%. Now we've got it back up, hovering closer to 2.5. So again, harping on that element of stagflation, people borrowing, people spending, which might be bullish for gold. I think it is good overall for actually the indices, just as a reflection of people spending, people willing to spend. CPI, again, year on year, you guys can see, this isn't core CPI, this is regular CPI, you guys can see increasing. almost reaching that 2 target, but now just increasing closer, inching to that 3, and you can see month on month actually increased from last month. So that was in December. Stagflation element again, inflation being sticky. PPI, which is Producer Price Index, which is another mark, although less than consumer price, obviously. You guys can see, again, it's sort of the same as CPI. You guys can see that general uptrend, especially on month-to-month basis for PPI. Once again, harping on that whole element of stagflation as a potential problem in the future. AU, the only inflation measures, we've got two inflation measures. We've got the trimmed mean CPI, which trims off any volatile items. You guys can see AU's actually coming down in terms of inflation, which is, worse for Aussie dollar, but better for, rate cuts eventually. Same as the wage price index, we see wage price index coming down, similar to trimmed mean CPI. So general trend down, hopefully getting to that 2% target so we can start to cut rates, people can start to borrow more, stimulate the economy. So AU coming down, not doing well essentially. So again, we're happy to trade AU short, depending on the technicals. Now GDP, that was what we were talking about. We had a hot reading for final GDP, 3.1%. Again, you guys, I've popped this box here. You can see we've got 4 quarters or 4 readings above the 2% GDP target. This is unheard of. US is the only sort of country getting these awesome numbers, so very good to see, very strong in the US economy. AU is a whole different ball game. We're under 2 for GDP. It's coming down, although it came up from the previous readings to 0.3. It was less than expected. Again, hopefully with a bit of rate cuts, we can stimulate this economy. We can bring this up, but right now it is falling. So there is a weakness in the Aussie dollar and the Aussie economy. Now we're looking at PMIs. 50% above 50% is expansion, below is contraction. You can see manufacturing's been below this whole time. It is starting to come back up. Apparently, from according to the last reading, at least, is the first green reading, which is a good sign. Services was the first time it went lower, which is interesting enough. But services has been above that expansion territory for many readings. So again, just sort of reflective of a good expanding economy. Consumer confidence, again, this was a reading this week, guys. It went down, did tick down this week. So in terms of projections, future projections has been a bit weaker than what we'd hoped for, but I think overall, with the other news and economic news, I think we're overall bullish. Retail sales above that 0 mark, expansion, people spending. Again, this is core retail sales without automobiles. This is with automobiles. You guys can see definitely retail sales are trending up. So quite a good reading. NFP, you can see employment coming up. This was the Boeing strike month, so sort of just take that out of consideration, but you guys can see that after the minimal rate cuts, we have got employment back up. We have job openings sort of stabilizing now, no longer going lower on the readings. We're sort of hovering around this 7.5 million mark, which is good. And then unemployment rate, this is a little bit concerning in the sense that unemployment rate ticked higher in the last month. If we get a reading coming back down to 4.1, that would be a good sign. Next week's data, nothing crazy. The only one I'm going to look at is probably manufacturing PMI. See how that goes. Might even have a look at China's manufacturing PMI as well, just to see how that goes, because that is going to affect the US after the tariffs come into play. But my biases. I think we can actually trade gold to the upside depending on the technical setup, because we've got uncertainty with tariffs coming up soon, as well as stagflation concepts, as well as rate cuts coming, which is overall bullish for gold from a fundamentals point of view. US 30, I'm still with this sentiment. We've got post-election, post-Trump, with the tax cuts, which should be good on a short to medium term basis for indices. We've got strong consumer sentiment, not this month, but previous month, as well as good retail sales, good GDP. Inflation, again, this is it's ticking up somewhat in the last readings, but it's still somewhat controlled compared to before. So I think we can still trade US 30 and indices long as well. And look, if we trade these two at the same time, again, depending on technical setup, we sort of have I guess, a somewhat of a hedge, because this is risk off, this is risk on. It sort of hedges itself back out. AU, we said we've got US bullishness, GDP, CPI, PCE, retail sales, as well as AU bearishness, poor CPI, poor consumer, Westpac consumer confidence. AU might be a good start to short. So let's have a look at our setups on a daily. We've added a couple more pairs, just the yen crosses, but both AU and JPI, both Aussie and yen, is weak, so I'm not trading that. AU, we said we can trade to the downside. I do have a play that I might make. We've got this nice support turned resistance that we might look to short there, depending on our news and how the setups play. But that's a nice markup. I'm just going to paper trade for that one for the time being. If it comes into fruition in terms of mid-Jan, when I start trading again, if that setup pops up, I might actually take a small, 0.25 or 0.5% risk trade on that, just to see how that goes. Dollar index, just to have a look, guys, we're trending up, so again, strengthen the US sort of dollar. UJ, we could trade this up as well. This is similar position to the Aussie in the sense that yen's quite weak right now. The only reason why I wouldn't trade it was the previous 4 weeks we had accumulation on the yen. People were buying the yen, so that might be a trigger not to buy UJ, but we're going to keep the chart there. We'll see how it goes. US 30, the biggest thing I want to see right now is it's sort of taken a bit of this support here. I would like it to come a bit further down to this territory here, and I might try again, if fundamentals are good, I might try short long that, have a position there, right, have a position there, let it do its thing, but for now, not touching that. And then gold, if gold can retest this support, I'm willing to trade that to the long side. Again, we've got elements of stagflation, we've got rates coming down, we have uncertainty with tariffs. I think gold is a decent buy. Will get taken out if it isn't. So yeah, guys, that's me for the week. No more trades for the rest of the year. Happy New Year, guys. I will see you guys probably in mid-Jan. That's when I'll start trading again.